Let's now talk about the buzzer today, and that's Federal Bank getting a big thumbs up after its earnings. Let's welcome on board Shyam Srinivasan, the MD and CEO at Federal Bank, joining in the show right now. Mr. Srinivasan, morning. Good to have you on the show, and what a mighty reaction coming in from the markets to your earnings. And clearly, you've seen strong growth, interest income, despite multiple headwinds that the economy as such as well has been facing. And we keep hearing that credit growth is supposed to slow down at a time like this. What are the factors that led to Federal Bank recording a growth despite all the factors that were at play? And which are the sectors which contributed to your growth numbers this time around?
Our numbers for Q1, like you pointed out, are quite encouraging. It's also because it's quite a balanced outcome. There is no one area that has sort of outdone or given us unique benefits, but it's been a sort of spread out between both credit and deposits. You may have noted our credit growth is Y-on-Y about 8%. It did have businesses like gold loan, parts of retail, and parts of the commercial banking do very well. In particular, gold loan had a remarkably good quarter where it grew sequentially almost 10% and Y-on-Y 36%. So the income growth of about 12% Y-on-Y has been helped by very good credit growth in the higher margin products and low-cost deposits also doing well. Our deposits CASA ratio moved from 30.5 to 32, so the 150 basis points increase in CASA driven by sequential growth of 7% in savings. So it's a fairly all-round improvement consistent with what we've been working for many quarters. And that's why the interest income was an all-time high at 1297 crores.
PCA ratio as well has seen an uptake. What's the update here? Where could exactly the PCA ratio averaging set in and hold out for FY21?
We would like our coverage ratio, including say the technical written off, to be well above 70%. Right now it's 75%, and we would like to keep that. Of course, everything depends on how the next say quarters, December quarter and the March quarter of next calendar year shapes up, given all that's going on in the environment and the challenges that we are all facing. But we will certainly endeavor to keep our coverage in a portfolio well covered, much higher than the likely loss given default. When our loss given default was early 40s, we had a coverage ratio which is higher, closer to 47, 48. When we visualize that the environment is getting stickier and the loss given default may go up, we took our coverage up to almost 59 right now. And depends on how things shape up, we are providing, will be well provisioned.
Mr. Srinivasan, hi there, good morning. Wanted to understand that now that we're 3 months into this financial year, what are the initial asset quality cues that you're picking up when it comes to your loan book? Do you envision that we could see a spike in NPAs in the coming quarters? Are there any particular spots that are a worry or a concern for you?
I think we're all part of the same economy, so we can't be totally insulated from all the challenges that globally everybody is facing given the COVID situation. Our portfolio generally is a more secured and a relatively more sort of higher credit standard book, as you would have noticed from very long. And our net NPA is at 1.22. In fact, it's at a 20-quarter low. All that gives us the confidence is that we are better placed now to face the likely challenges that may arise over the next 6 months, 9 months. And we've made provisions, and we will certainly keep increasing the coverage as we at every available opportunity. And the post moratorium lift off is when you can really make sense of how the credit books of everybody is performing. And the visible impact will be in September and in the December quarter. And I can't quite tell what level of deterioration, if any, will happen. But we are preparing the bank for ensuring that we make our best effort, are in continuous dialogue with the customers, and hopefully the deterioration is manageable. But we will keep well provisioned.
All right. Now, despite us seeing your NII growing, your operating profits sequentially has seen a decline. What was the reason for this, and are there any cost-cutting measures now in place that the company, or the bank rather, will be taking up?
I think the sequential number on operating profit may not reflect the reality, because last quarter we did have significant one-off gains on treasury and sale of investments. Those were not there in FY21 first quarter. So to that extent, the Q4 last year had some gains, which are not one-off in nature, though that didn't repeat in Q1 of this year. So actually the 932 crores of operating profit in Q1 and 959 in Q4 last year, both are by way of record the highest ever the bank has done. But the 959 had some larger one-off gains because of sale of investments, which don't repeat itself. So in that context, Q1 932 is a more sustainable, credible, consistent number. Operating cost efficiency increase, that's the productivity drive of the bank. We have many elements of activity going on, and that will continue to improve. But will it sort of dramatically reduce? It will play its own course, because we are automating, centralizing, standardizing, renegotiating, deferring a bunch of stuff. Because in the current environment, you don't know how much you can believe in the top line opportunity, so you have to make sure that the costs are well maintained.
What then is your guidance for net interest margins going forward?
If you see last 3 quarters sequentially, margins have been moving up between 4 basis points one quarter, 3 the next quarter. In the normal course of events, I would have said we would be tracking the similar kind of rate of increase. But we are in a relatively low interest environment, so to that extent margin expansion doesn't happen significantly. Second, as credit slippages increase, which is likely to happen after the moratorium is lifted off, you will certainly have impairment. If the impairment is there, then there is a revenue impact too. So I can't quite comment. We will certainly seek to keep this level of margins is the number one effort. Improvement on this, we will see how things shape up in the environment. I think the next 2-3 quarters are not going to be sort of very typical of how businesses are run, right? We are all trying to make sure that damage is less, we keep the franchise intact, we keep our people safe, we make sure that we are doing the right things for the customers. So it's more like hygiene management over the rest of calendar 20 and early 21 till sort of world order stabilizes, a vaccine is found, and life gets back to some kind of even keel.
Right. What percentage of your book which is opted for moratorium do you actually see going bad? I'm sure you must have done some back of the envelope calculations and assumptions.
Very hard to tell, because we should not make a judgment that everybody in moratorium will go bad or everybody not in moratorium will remain good. These are evolving, because people who had taken a moratorium may have come out of it. Some new areas are going into lockdowns and they are facing challenges. So I think it's a kind of a mixed environment. Most people have not changed their intent. In fact, many people's intent has only increased to keep their track record clean. But their capability may get temporarily impaired, and that's why the moratorium and the various restructuring opportunities that may come will all help people manage their finances better. My general belief is that people will make their very best effort to remain with a good credit track record, because everybody realizes that a impaired track record means future borrowing is a big challenge for them. So I do think most customers will make a very, very significant effort to ensure that they keep their payments going.
So I'm sure, Mr. Srinivasan, now a lot of investors are curious to know that basis what you've done in Q1, do you think that we can continue to see an extrapolation of this kind of a performance? What is your guidance when it comes to credit costs for the rest of the year?
Yeah, I keep saying, right, it's hard to tell. Q1 was 83 basis points. Q4 of last year was 138 basis points. So we have like 2 data points to play with. Our most optimistic view before all COVID broke out was this year should be a 60-65 basis points credit cost year. We do believe that that is almost unreal. So it could be anything 80 to 130 kind of numbers. We'll have to see how things shape up. But I'm making no judgment yet. We are providing well. We are working very closely with our customers. We have to see how things shape up.
And finally, you have former veteran bankers like KV Kamath step forward and say very openly in the newspaper that banks should play their role in stimulating the economy. They should not pay too much attention to the credit ratings of corporates. What are your views on, these very forthcoming statements? Do you think that taking on such a risk would be justified from the bank standpoint, or would you be a little bit more conservative?
View is always balance helps. We have never been a bank that has done 50% growth or 2% growth. We've grown ahead of the market at least for the last say 14 to 16 quarters, and that's a good track record to have. I do believe this year when everybody is reporting close to zero, we've shown between 8 and 9% growth. Last year we grew 11% when the industry grew 6%. So FY21, if the industry grows 2, 3, 4, 5, I don't know what, we should grow 10, 12%. So we are in the market. We will grow the right segments. I am not saying that we will go and do, sort of jump off a cliff, but we will be very sensible in our lending.